I beg you on my knees, never and ever make your body to a point looking as cureless, as here. Starving children in Africa will be nothing in comparison to this. Please don't devastate yourself. Even if food prices are getting into your nerves, don't really do it. Otherwise, you'd have to get this intravenous therapy, as Fed would need to take this another fiscal drip. So that's a tip for you today. You have another edition of your informative pill. That is a Blockrevision episode. Great to have you here. Thank you for tuning in. So let's jump into another episode. So we are at first getting into our presentation, and that will be just tuning in, right? So and all right, there is a slideshow. We are starting off with economy view, and we have this job openings data recently been out, and this one suggests that we may be heading an inflation point in terms of US vacancies that has recently unexpectedly risen to 11.2 million, but looking as getting more flatline than it been back previously. So right now we can find that data suggests a shift toward more conservative pace of hiring. Right now we have seen a decipher in some of the economy's gauges that is signaling that we might be heading throughout more turbulent time ahead. And this one, according to ADP data, US private employment levels are back to pre-pandemic highs. But anyway, Fed is probably going to do whatever it takes to bring down inflation, even if it would need take sacrificing the condition of economy. So Fed right now finding this is eventually not a one and done period when after hiking interest rates we may find that there will be a long extending period of where we may behave in this upper interest rates levels. And Master of Fed said recently that while answering questions from the audience that they gonna have a little bit more problematic time ahead, as problems are getting into their sheets, and eventually it will lead to possible some drawdowns on the markets. So they will act possibly as the guy that always spoils the party, and that's definitely not the Gatsby party at all. Right now we are deteriorating in many of the conditions of the US economy, and it may only get worse. Possible relief is predicted for the next year, but for those that were hearing that inflation is transitory back in June and July of 2021, we may find that the underestimation is the ball and chain in Fed's logical deduction. So be that as it may, we may be entering this long journey of high interest rates, hopefully not as stormy as in 70s. COVID fear is fading. Fortunately, that's a factor that may take the burden off the economy, but hurdles to fully returning to offices following COVID-19 pandemic maybe not getting totally removed, but getting raised to that extent that it shouldn't really bother the performance of those companies. Unless it will eventually get back in a worse stance. So getting back into this, where we might be in this bubble burst scenario, there are many voices that we are right now facing a bear market that is divided into 3 phases. The first one was a little bit mild. The next one is severe, but the third that might be ahead of us is the largest, where the biggest declines appear. And when bubble forms, then we have a setback in valuations, as we had there that in the first half of 2022 that occurs as investors come to realize perfection won't last. After that, we have the bear market rally as back we just been going through during July and August. But then all of a sudden fundamentals deteriorate even further, and we have a drop to a lows, where largest declines come in the last third, and that is at around 60 up to 70 percentage points, where the possibility of those declines may appear. So average decline in the last third double that of the first or second third. The market is looking for a sign for a recent reversal in the housing market. Predictions for that market are still fine, but many, as we can find, many of that over-optimistic insights seems unwarranted. So that's something that I need to point you. United States NAHB housing market index right now is pointing that we might get through with troubles, but with this financial conditions getting worse eventually, it may get to look a bit more dicey from here. United States building permits, however, this one is getting lower due to this mortgage rates getting higher, and that's something that is lowering in projections. But if we just have a look at housing starts and new home sales, this one pointing that we are already over the trouble, but this inflation and also problems with very high prices of commodities still are retained in the economy, and I do find that that will be not a smooth sailing for this to happen, and the reversal will take much more time. So this is another pending home sales and case-share per home price, the indicator that tend to follow other tendencies already been mentioned. That's why I am a little bit more skeptic regarding this one, because nobody knows how much real estate prices, not just in the US but globally, were increased by quantitative easing. There's pretty strong consensus that QE did boost asset prices, and they are wanting to keep them up now, but it does for now wages keeping them some concerns that the wages may eventually get worsen. So you have to remember that housing market is a leading indicator. The GDP is the lagging one. But you have to remember that when the debt collapses, as we are right now in not only Venezuela, but also getting worse in United States, that is exceeding 100 points, we are closer and closer to a default scenario where all the assets that were supported by this debt will collapse, and that would mean a possible end for the US dollar. We may all be paying for US dollar to devaluate when those problems with maybe rising risk of hyperinflation will eventually turn out. So this could be the hand central bankers are playing, especially through the looming issuance of central bank digital currencies that may get introduced in the next 2 years. And the issuance of digital currencies controlled by the central banks would eventually annihilate the banking system, make it an obedient follower of central bank policies, and you may even be controlled over what types of products you are spending your money, and where you are pushing the capital flow the direction to. So that's a very, very dystopian vision, but still possible. In terms of market outlook, I have an insight in what's going on in Europe. So emotions driving valuations, and in fairness, a big part of the shock drop in sentiment was the headline fear factor from geopolitics. But even with further hiking prognostication, it's not entirely possible that the ECB doesn't even get to a chance to hike rates or finds itself back in renewed easing. So with the Eurozone inflation rate hitting a record high of 9.1%, it's needless to say that investors are right now with more of an eye on downside risks than upside risks, given the prevailing macro currents. So definitely the stocks may follow the sentiment, but the sentiment is already very low. That's why, as it haven't been discounted, this very low sentiments yet, that may not happen, at least for now, as we are waiting for economic fundamentals, not only sentiment analysis, but that's something that may also spook the fundamentals in the longer run as well. So that was Europe. Right now, let's jump to crypto. So what September may bring for the market? There are heavy clouds of impending Mt. Gox release, and that one has been rolled over for possibly the end of September, but there are not exact date being revealed yet. September usually is much worse for many assets on the market, and not only for crypto. That's why, as the correlation between crypto and other traditional assets is getting up to 0.8 point, that would mean we should expect a lower performance from crypto as well. So the only one savior might be this, if even this merge that may happen in the somewhere around in 2 weeks, and may this event be so prominent that market seasonality maybe not even got into consideration. I would study the if in technical aspect at the end, as I just let you know out that trade idea section will based on if if analysis, but for this one, market was already betting for higher valuations, but has tremendously surprised as had a slump in the face by many liquidations that have been taken on the market. So will that just be another sell on a news event that should be on, not off? We do think so. Volatility may spark another wave of interest, and that's something worth studying. And we can find that organic rally comes when there is a high trend of inflow to spot exchanges. Right here, while the inflow and reserve in the spot exchange are low, the futures are relatively active, and that will come possibly anytime soon. So in 2019, back then, we have seen rising at this baseline, getting closer to this baseline, being set at around higher levels, and with that rise been still permanent. We may find that right after those fundamentals being observed, and after this accumulation process being ended up, we started very short rally, very short in terms of time, but very extended in terms of price. So it's very strong indeed. Rally that took us more than 6 months. So not counting this one, the second top. So estimated leverage ratio right now is pointing that we are somewhere around the possible point where maybe after Labor Day, where investors will return to the markets, there will be possibly more room for equity volume to catch up with levels of stress in this type of asset class. Fundamentals been delivered. So fundamentals are been based on a hash rate in terms of network difficulty, and this one with miners not escaping of the difficult environment, and also this regulatory pressure is a bullish sign for the market. That's one of the signs that are building up and kinda gaining power little by little for the next growth in price. So the not only network difficulty is rising, but also adoption of Lightning Network, but I don't have the chart of this in this presentation. In terms of security tokens, you need to verify twice, make a double check in terms of whether you are not keeping these security tokens in your wallet, but that might be very difficult to say what are the security tokens at all, as we haven't seen a strict and clear guidance of what that may be. So everyone is building the infrastructure. You don't have to be a programmer determined by hash rate rises, and that's something that is been pushed to the pushed on a fundamentals of the market. But in terms of security tokens, whenever we are seeing the push into those fundamentals, we may see also this rule-making process that been taken. So securities are not probably those all proof of work, not pre-mined tokens, but Zcash has been premined. That's why you need to take a little consideration of the token might be in trouble. Horizon also, because Gary Silbert has also announcing that after the initial token offering, there is a likelihood of a token to rise. That's why there might be consideration of those two tokens being securities. How much are crypto engineers paid? And we can find that those wages are really high, but will those wages be really maintained in this turbulent time with hiking interest rates and economic slowdown? That's a very tough question to answer. Possible outflow may also put pressure on valuations of many crypto assets as the quality of services may deteriorate. So, on the other hand, with this difficult time to fade and regulatory uncertainty to get out, we may observe another flow of talents that are supposed to be replaced, replace the possible dearth caused by market troubles. The market, thanks to its destination of revolutionizing the way we are thinking of money, is highly absorptive for new highbrows. So I do find that after making this cycle, those developers will return, even if switching temporarily for another type of occupation in another programming sector. So let's get into market mover section, and here what we've got, we have on Thursday. Let's get quickly through Wednesday, as it already over. S&P Global Manufacturing PMI from Australia. Australia is this commodity country that shouldn't really suffer from this economic slowdown to a large extent as their peers do, their global peers do. I mean Europe or US. About Thursday we have this inflation rate out of Switzerland, and this one obviously is maintaining at the similar level of 3.5%, so it's still satisfactory for this central bank of Switzerland. On PMI gauges of Europe, we still on the verge of a possible deterioration. We can find that Great Britain is the country that on which still the burden of economic downturn due to this Brexit still remain, and in terms of other countries, we can find this PMIs are getting little worse for the entire euro area, but let's have a look at France. In terms of France, it's getting better, but Germany is still in this very strong downtrend tendency. So let's right now have a look at another thing in economic calendar, and tomorrow we'll have a non-farm payrolls. That is one expected to remain at around 300 levels. Recently was very huge spike, but shouldn't been really kept up. So also something that is worth watching is average hourly earnings from United States, as it's one of the leading indicators. So let's right now get into a I need to change the window that will take second. Something is stopping us from going forward, so I will just show you in another window. So for today, as promised, I was about to show you out the Ethereum to USDT, and this chart is right now in a very difficult position where we have in 2 weeks emerge the very important event for Ethereum to happen. I'd rather find that there will be a small surprise to what already been delivered in terms of price action. So I'd rather find there will be much more of a stagnation, but we may get back to around this previous resistance levels. I do expect this one to happen as exchange net total recently has spiked, but in last 7 days we also had a real liquidation that spooked the Ethereum market. So I'd rather find this one to remain at these levels, as lots of investors has been disappointed by not enough impetus in terms of price action. We also seen exactly this one, the biggest decline in Ethereum funding rates since June 2021. So it's something that also bringing us to a conclusion that this recovery need to take much longer for this sentiment to be going through the full cycle. In terms of Ethereum to USDT, looking just at technicals, we may find that right here on a weekly chart we haven't confirmed the very strong, very important, I would say, high of April 2018. That might be another stop for Ethereum after this sell-off post merge may take place. For the prices in a longer time horizon, the very important for the crypto to remain to its recent trajectory of growth will be heading past recent highs on 1700s, and right over I may consider possible long position right from here. If the rebound will be stable, I would consider such of a move with an entrance right at 1711 and with a stop loss right around 1600s. But I don't find there is a more likelihood for now that will eventually have this rebound by March, but that wouldn't be so strong. So I'd rather expect this one to slump to around 30-ish hundreds within next 2 weeks, rather than having another exciting rally upwards. So if the price won't hit this level on a satisfactory level, satisfactory volume, and with a slow and consequent movement to appear, I wouldn't consider this proposition of a trade as being valid. For now, yeah, that's everything. Thank you very much for tuning in, and If you have any questions, just put it in the comment section below the video, or and I will just turn to them as soon as possible. Thank you very much, and bye bye.